All right, everyone, welcome back to episode number 6 of the Smash Property Insider podcast. I'm your host, Nick V, and with me today, as always, I have my life and business partner, Akira. How are you?
I'm good.
Excellent. The catering in this place was really good.
It was good.
Yeah, it was good. Yeah, I'm coming back. In this episode, we're going to be talking about having realistic expectations when it comes to your property investing journey. There's a bit that we'll kind of dive into, but I think a super important one for new, in fact, all investors.
Yeah.
But I think if you don't have a property right now and you want to get into the market, this is probably going to be a really good episode to really just give you maybe a bit of a reality check, to know kind of what's coming, what to expect, what to do, what not to do. But also clarity. But also if you've got a couple of properties, like we've spoken to some people in the past, they also don't have realistic expectations sometimes.
Yeah.
So we're going to unpack a little bit more about what that means. So why don't you sort of kick us off with one of the first realistic expectations that people need to have?
I guess the long-term goal is really important to understand when you're asking the question of why you're getting into property, especially as a new investor.
Yeah.
A lot of people want passive income off the bat. They want, they want to have like 10 properties within 3 or 4 years, which, I mean, definitely possible if you've got servicing for it.
Yeah.
But it's just one of those things with, I think social media and different people talking about property nowadays.
It's a bit muddled up with that whole thing.
Yeah, it's understanding that not everybody is made equally. Everybody is starting from a different point one.
100%.
So it's just maybe unpacking it and understanding where you're at and making sure you provide yourself the tools and I guess right perspective to get you to point B in a realistic manner, and one where you don't get deterred from the goal by the setbacks that you may have, right? Because it's one of those things with property, there's always going to be roadblocks.
There is. So I think the first realistic expectation that people need to have is understanding that the market moves. Yeah. Right? And it's not a linear movement. It's a cycle. Yeah, right?
Cyclical.
It's a cyclical thing. Thank you for correcting me with that thing. No, sorry. This is actually really important. So the market moves, and what has worked for investors 5 years ago, 10 years ago, 15 years ago,
3 years ago.
Exactly. Doesn't necessarily mean it doesn't work now, but it's different now. Why? Because the market's different. So what happens is we've got a property market cycle, and think of it like a clock, 12 at the top, 6 p.m. at the bottom, and it's just sort of moving around in the sense of prices will peak, they will then stagnate, they may even fall back a tiny bit, the market will start to pick up, and then it will peak, and then it will just rinse and repeat.
And it just goes up in price and then continues to grow.
In the main capital city markets, absolutely. Yep. So we've got a property market cycle that's doing this, right? But we also have a interest rate cycle doing maybe not the same thing, but the interest rates are influenced by so many other factors. As we've seen, they were at record lows for many, many, many years. And this is where, for example, cash flow positive properties would have served you very, very well because the money was so cheap. It didn't cost you a lot to hold the property.
That's right.
Now, interest rates being 6-7+%, that cash flow thing doesn't work anymore because even if you had like an insane yield on a property, right? It is barely going to cover all of the expenses plus the mortgage in today's environment. So this is where understanding that this market is going to move, and therefore your strategy that you have as an investor needs to fit the current interest rate cycle, the current property market cycle, so that you can get the best out of it.
Preach. That's very true. Because I think at the end of the day, when you're looking at it, property investors 10 years ago are doing super well because they've got inflated money.
They were in the market. They bought when the money was so cheap, right? And they've ridden that wave up. And I think before, because a lot of people would be like, oh, well, we've missed out. Well, that's not what we're trying to say. Is the point being is get into the market because you can ride that wave that we're going to go through over the next, 5, 10, 15 years.
That's exactly it. And I think you just touched on a really interesting point there. It's always better to be in it than not be in it. So setting yourself up with a realistic expectation of when you're actually going to pull the trigger is super important as well, because it's so easy to say, oh, interest rates are too high.
Yeah.
Oh, it's too expensive to like actually get it. I'm not going to be able to afford it. To be fair, I couldn't afford it, but then you make ways to do it and you figure out what kind of strategy will work to offset your property portfolio.
Exactly. We was talking with someone in the last couple of weeks. It might have been Tony, actually. Shout out to Tony if you're watching this. Okay. We were talking about like people kind of what you were just saying there. There's so many things that can go wrong. Oh, I can't afford it. Maybe maintenance, or maybe this, maybe that.
Yeah.
There are so many things that can go wrong, but you also got to ask yourself, what if it goes right?
That's exactly the thing with property investing. It's like a risk and and it's your mindset. The first episode I think we did, there's 1,000 reasons not to do it.
Yep.
There's probably only a handful to do it.
100%. So I think having a realistic understanding of, yes, the market moves, yes, monetary policy changes, and therefore interest rates can do whatever, up, down, or whatever. Just knowing that is happening, and the strategy that is worked for you and I over the past couple of years may not work for people in the next 10 years. Do you know what I mean? So just really understanding where you are right now in the whole stratosphere as a person, as an investor.
As a human being.
Yeah, like where do you sit? And then like just, putting a plan together. Like you kind of touched on it in the beginning, like just having a plan. And I've mentioned it in another podcast. Even if you're not super clear on what it is, have a vision, have something that you want to aim for, like, because that will just make your journey just so much easier. So the next realistic expectation, and this is there's a couple here that I get quite passionate about, because
maybe we need to dial them back.
Because we talk with potential clients and actual clients. Our actual clients are great. The potential ones, maybe not. No,
Don't say that.
No, so the financial freedom component.
Stop it! I'm gonna laugh.
Now you can. No, you can laugh. No, this is a serious topic. You can't laugh. No, you can.
It's just such a hook word.
It is, and social media hasn't helped with this. I was thinking about this a lot in the past couple of days, but the reality of financial freedom. What does that mean? Yeah. Like, what does it mean to be financially free?
Honestly, it's like anything. It's got so many different meanings to every different person.
Exactly my point. It's got so many different meanings, and it doesn't matter what it means to anyone else, except what does it mean to you.
That's right.
Okay. And I think, so maybe there's a couple things I want to unpack here. So the meaning of it, what does it mean to you? And it doesn't mean you've got to be a baller flying in private jets. Hey, that might be great for some people, but it could mean 50K passive income.
Yeah.
Your basic needs are taken care of. You don't have to stress. That for some people might mean, hey, I'm financially free.
Exactly.
And that's an amazing place to be. So work out what it is for you, right? Number one. Define what that means for you.
Quantify?
Quantify, qualify, I don't know.
Put a number to it.
Put a number to it. Yes, that is quantifying. But this is an important one I want to get through here is have the number, know that you want to do it, but just know that it's going to take time. And I can't stress this enough through this microphone. It is going to take time. Number one, it is going to take sacrifice. You're going to have to work your ass off to get it. It's not if you have no properties right now and you're earning 50 grand a year and you call and you want to be, financially free within 12 months and have, 100K passive income. I'm sorry, unless you have won the lotto, you've got some money coming in, that's not going to happen. You can do it over time, but you're not going to get it in that 12-month period.
Especially in this market cycle.
But I think just in general, right? So have your thing defined, whatever it might be, and be real with yourself around how much money do you actually need? Because when you break it down, most people don't need a ton of cash to really be free and have that stress lifted off their heads.
That's right.
But I think importantly is having the realistic expectation of what it will take to get there.
Yeah.
It's not an easy road. That's why not many people get there.
Mm.
But put a plan in place and just consistently work towards it, and it will come to reality.
And it doesn't happen just like it just there's no day where it just happens and you're like, oh, I'm financially free. It happens over a period
Slowly
of time.
over time. And like I remember we've spoken with there was a seminar we went to. There was a few investors that had double-digit portfolios, and all of them that we spoke to said like they didn't wake up one day and be like, oh wow, like I'm financially free today.
That's right.
It just kind of slowly happened over time, and then before you know it, you're like, hey, I actually don't need to work anymore.
Yeah, I don't want to go there anymore.
Hey, I don't have to do. Hey, I can just do my own business now. I can do this now and do that now.
That's right.
Like it's just a slow kind of realization.
But I think what you had an amazing saying, especially when I'm cooking or going nuts in the kitchen. Slow is smooth. Say it to me.
Say it to me one time. Slow is smooth and smooth is fast.
I think that replicates the property investing journey.
100%.
Do it right.
I think that's a old Marine, US Marine quote. But yeah, it's so true in so many areas of your life. If you just kind of slow it down a little bit, you'll actually end up getting there quite fast rather than rushing, making mistakes, going back.
Tortoise in the hair.
Exactly right. So financial freedom, be real with what it is and what it means to you, and be real with what it takes to get there, because it's not easy. Okay. And that's, I feel like I kind of preached a little bit there.
Went into dad mode.
Cash flow. There's another one we spoke about.
So cash flow is an interesting one. I feel like I have the privilege to speak to many people, obviously, with my role as a property strategist. Everybody wants cash flow today.
Yeah.
But I think I realize now, after speaking with people and understanding who you are and why you want that is really important. If you're getting into property for a couple of years, probably I can see why multi-living kind of like properties are going to be valuable to you. However, if you're doing it as a long-term investment, that you're looking to grow a sustainable property portfolio, cash flow just comes as a consequence of holding the property.
Yeah.
I feel like you articulated actually this in a really concise video with running the numbers, which maybe we link down below.
Yeah, there is a YouTube video out there. It's like a couple of minutes long, and I sort of whiteboard the difference with, a negative cash flow. And yeah, we'll link it below because it is, I think it explains it quite well.
Yeah.
But I think maybe just kind of linking on to what you said there, like we get a lot of people, and I think because people see the interest rates being, where they are right now, super high, rightfully so, they're very concerned about holding the property. Like, this property is going to cost me a lot to hold it. Therefore, I want to invest in an area that has a high yield, i.e. a better cash flow, which is like fundamentally like the right mindset to kind of have.
Yeah.
But again, I think we mentioned it in another part, the bigger picture, like what is that $100 a week positive cash flow going to do for you right now? Especially
if you can afford it.
If you can afford it, yes. Yeah. But that aside, like what is that $100 a week going to do for you in the now?
And today's money too.
Because if you're getting a property right now with interest rates being 6.5%, 7%, you're getting it to cash flow $100 a week, you are either buying, one of these co-living types of properties, or you're buying in a super regional location, both of which, what are they going to do for you in the long term? Like, what is the net benefit that you get out of holding a regional property that cash flows $100 today? What is that going to do for you in 5 years, in 10 years? Is that property going to grow in value enough for you to actually have like a sizable net worth and a net position where you can sell down some assets and reap the benefits of it? Or is it going to just stay the same price?
And are you then going to be capped at borrowing with that?
Exactly right. So like, I think there's a lot of people that kind of have that mindset. And like I said, it's great. But just again, what is the bigger picture here? What are we trying to achieve? And kind of going back to what we said at the start is like, have that goal.
Yeah.
Because that goal
is going to
allows you to then buy the right property now, so that in 5, 10, 15, 20 years, you can get to that goal.
Exactly. And look, it's a layered kind of decision that you have to make. You've got to understand your lifestyle, your circumstance. Are you able to service? What does that property at that specific time mean for the overall projection, as you said? And I think it's coming down to be brutally honest with yourself and running your numbers. Honestly, like not enough people actually run the numbers to actually know what the difference is between $50 negative versus $100 negative, and what that looks like over a five-year period.
That's the key, right? Because I think people look at the cash flow now, great. Look for it in the long term,
based on the growth rates. And
factor
like
in, price increases, inflation over that time period, right? Because it's gonna happen. Your insurance is going to inflate over time. I know it does, but it's so important because it's like, okay, if it's negative $100 a week now, what is it in 5 years? Because it might be, $1,000 a week positive. You don't know.
You think about it very simply, is a couple of rent increases, 1% interest drop on the rates.
Yeah.
That property is fine.
Yeah, no, I mentioned that to a client yesterday. It was like, the rates are, terrible right now, but all it takes, a couple of rent increases, couple of rate drops, and you're in a different world altogether.
Yeah,
so,
exactly.
Yeah.
You can retire.
Yeah, that's the name of the game for some people. Although I don't want to retire.
Yeah, I love what we do.
I've been doing this, rocking this boat for a while to come. So we have realistic expectations. We've got understanding or being real around the market movements. Know that things move in a cyclical nature, as you mentioned. Be realistic about your financial freedom expectations. Like, what is it for you, number one, and how quickly can you get there, and understand it's going to take a bit of work.
Yes.
And then be real around cash flow. I think this is like a bit of a stickler. Yeah, it does, because it's like,
can I be, not to be off topic, but I think it's like most things in life. I'll just use a relationship as an example. If you do the right foundation by creating that respect, like trust between two people, it's like love. It comes as a consequence. Cash flow is like the consequence of having a stable portfolio.
The relationship queen, Akira, dropping some gold for you guys.
But I'm just saying, it should be a consequence of holding a good asset.
100%. I think you actually, that's a very good way to frame it. It's a consequence of property investing. And I think, just like, I'm going to throw it out there, like, if you just want cash flow, there are so many other better investments for cash flow. Like, why do property?
That's a high risk asset if you're looking for cash flow. Yeah.
Yeah. I think properties, build your net worth, leverage your money, go from there. Long term.
Marathon.
It's a marathon. It's not a sprint, guys. So I think that might cover the realistic expectations. I feel like we could probably ramble on a little bit more about some of that stuff, but we won't bore the guys watching this. So look, thanks again, obviously, for joining us. I don't know why I thank you every single week, but
I love being here.
Thanks
Thank
anyway.
you for having me.
And thank you for all of you guys watching again, the Smash Property Insider. This was episode number 6. So thank you for tuning in. Obviously, every week, every Wednesday, 7 p.m, live on YouTube and Spotify. Well, it's not really live, but you get what I mean. YouTube and Spotify. Thanks for watching, guys. Until next week, we'll catch you soon.
Thank you.